Okay, good afternoon, everybody. Thank you so much for being here. It's a joy to see everybody today and to have a full space. My name is Elizabeth Larson. I'm the Associate Director at the Weidenbaum Center here at WashU. It's my privilege to welcome you to what is truly a history-making occasion. For the first time ever, 3 presidents of the Federal Reserve Bank of St. Louis, past and present, will be together on one stage. This is a rare opportunity to reflect on the past, present, and future of one of the most influential institutions in economic life, right here in the city where the St. Louis Fed has helped shape policy and markets for more than a century. At the Weidenbaum Center, our mission has always been to connect high-quality and thorough scholarship with real-world policy conversations. Today's program exemplifies that mission. We're bringing together leaders who have shaped the Federal Reserve and inviting all of us into that dialogue. So before we begin, just a quick note. Questions for today's conversation were submitted at the time of registration, so we won't be taking any questions publicly during today's program, but I can assure you Karen has used many of your questions for today's program. I also want to add that WashU is committed to the free exchange of ideas. And in that spirit, we ask that all of our speakers be shown the respect and courtesy that they deserve. Anyone who can't do that will be asked to leave. I also want to remind everyone that the Weidenbaum Center has a semester full of fantastic events, and you can find all of them on our website. Many of our events are also listed on your event program, which all of you should have received, and the flyer. So again, thank you so much for being here. It's an honor to have you all with us today. It's also my great pleasure and honor to introduce Washington University Chancellor Andrew D. Martin, who will open today's program. Please join me in welcoming Chancellor Martin.
Thank you very much, and good afternoon, everyone. Thank you so much for joining us today. I want to extend my appreciation to the Federal Reserve Bank of St. Louis, the Regional Business Council, and the Weidenbaum Center for making this gathering possible. I'm also pleased to acknowledge our partners at Purdue University's Mitch Daniels School of Business, who joined us as co-sponsors of today's event. The Weidenbaum Center at Washington University has earned its great reputation by doing something essential, bringing people together who might not otherwise sit in the same room: scholars, policymakers, and citizens, Democrats and Republicans, theorists and practitioners. These conversations matter because the best ideas emerge when different perspectives meet on common ground. Today's event is a great example of that. Washington University, Purdue University, and the Federal Reserve Bank of St. Louis share some commonalities. Each of these institutions is deeply rooted in the Midwestern region, and we each work toward the prosperity of the people, families, and businesses located here. But the work that takes place in our respective campuses reaches far beyond the region to influence policy and shape knowledge across the nation and around the world. Institutions that effectively serve the public good understand they must be both good neighbors and strong national leaders. The questions we're exploring today about economic policy and financial stability affect every American family. So thank you for participating in this important conversation and for your continued support of the work we do together. I would now like to introduce Andrew Reeves, Professor of Political Science and Director of the Weidenbaum Center, who will introduce our panelists. Thank you.
Thank you so much, Chancellor Martin. It is a privilege to welcome you on behalf of the Weidenbaum Center on the Economy, Government, and Public Policy. My name is Andrew Reeves, and I'm a professor of political science as well as the director of the center. Our center was founded by Murray Weidenbaum, Murray was a renowned economist, advisor to multiple presidents, and a longtime WashU professor. The center was founded on the conviction that scholarship should not remain in the ivory tower. Rather, it should inform the policies and practices that shape our civic and economic life. That mission guides us still. At the Weidenbaum Center, we support rigorous social science research, and we are equally committed to translating that work into meaningful public dialogue. We strive to serve as a bridge connecting scholars, policymakers, students, and community members in conversations about the issues that matter most. Today's event represents that mission at its very best. This is a historic moment. At a time when the Federal Reserve is front page news nearly every day, we are extraordinarily fortunate to have these leaders here to reflect on their experiences, perspectives, and the institution's future. We're also very grateful to Purdue University's Mitch Daniels School of Business for co-sponsoring this event, and we warmly welcome the Purdue guests who have traveled to be here with us today. Now, let me introduce our panelists and moderator. I'm going to give very brief bios because you probably already know these folks, and if you don't, you're going to learn a lot about them during our program. Alberto Musalem is the president and CEO of the Federal Reserve Bank of St. Louis. In this role, he participates on the Federal Reserve's Federal Open Market Committee, which meets at least 8 times each year to set the direction of U.S. monetary policy. Thomas C. Melzer is a co-founder and managing director of Rivervest Venture Partners, a venture capital firm headquartered in St. Louis, Missouri. Melzer was previously president and CEO of the Federal Reserve Bank of St. Louis from 1985 through 1998. Jim Bullard was chosen in 2023 as the inaugural dean of the Mitch Daniels School of Business at Purdue University, and he is also a distinguished professor of service in the Daniels School's Department of Economics. He served for 15 years as the president and CEO of the Federal Reserve Bank of St. Louis from 2008 to 2023. And finally, our exceptional moderator, Karen Branding. In addition to being an alum of WashU, Karen is the president and CEO of the Regional Business Council. Before joining the RBC, Karen was senior vice president for external engagement and corporate communications at the Federal Reserve Bank of St. Louis for 13 years and its corporate secretary. Thank you all so much for being here today. Please join me in welcoming our extraordinary panel.
Greetings, everyone. Thank you so much for joining us and for all of the questions that you submitted when you registered, almost 90 of them. And I want to assure you that they helped frame the questions that I'll ask today. So I thank you for that. You know, it's not uncommon for the Regional Reserve Bank president to get out into the community and dialogue with people. That's part of the job. But what is uncommon is to have a current Reserve Bank president and 2 former Reserve Bank presidents out in the community together for dialogue. We are in for a real treat today. And I want to thank the Weidenbaum Center for making that happen. It's so WashU for you all to be bringing people together. Okay, with such a large audience, here's a quick Fed 101 to level set. So 3 things. First, the Federal Reserve is made up of 12 regional reserve banks plus a board of governors in Washington. Second, the Congress set it up that way in 1913, so it's not a Washington central bank, it's not a Wall Street central bank. It's a central bank system that distributes reserves and decision-making and operations across the country. 3, the Fed's policy rate, or the Fed funds rate. It's one of the key tools that the Fed uses to manage the economy. So to keep inflation in check, the Fed raises the Fed funds rate to cool off the economy and make it more costly to borrow. And conversely, to stimulate the economy and bring down unemployment, the Fed lowers the Fed funds rate to make it less costly to borrow. Okay, that's the 101. There you have it. Let's dive in. So let's start with the dual mandate. So since 1977, the Fed has operated under a mandate from Congress to promote maximum employment, stable prices, and moderate long-term interest rates. Three things, but it's commonly called the dual mandate. I'm sure we're going to have someone explain that to us. But let's start with you, Alberto. So, Alberto, the aftermath of the pandemic, it's been a challenging time for the Fed because two of these goals are in conflict with each other. Tell us how the Fed is balancing the need to control inflation without contributing to high unemployment. It would seem really hard to address one without making the other one worse.
Thank you, Karen. Yes, it's working. Okay. I'd like to also thank the Weidenbaum Center for hosting this fantastic discussion. I'm very privileged and honored to share the stage with two former presidents that did so much for the Federal Reserve and for the nation as monetary policy makers. And I'm really pleased to be able to serve the communities of the 8th Federal Reserve District. So when the employment and inflation goals of the Fed aren't always in tension, but sometimes they are in tension. And when they are in tension, the appropriate thing to do is to follow a balanced approach. And a balanced approach means when you only have one instrument, which is interest rates, and you have to hit two goals, a balanced approach is about evaluating the probability of missing on each goal, the likely size of the miss, and the likely duration of that miss. Now, a balanced approach and the dual mandate works if inflation expectations are anchored. And right now, inflation expectations are anchored. The short-term expectations are somewhat high. Long-term expectations are anchored. When I look at the economy today, how it looks today, how the balance of risk and outlook look into the future, I see an economy with inflation running closer to 3% than to our 2% target. The labor market near full employment, both with some signs of weakening. When I look at the future, my expectation is that inflation will stay elevated for 2 or 3 quarters while the tariffs play through the economy, and then inflation will begin to converge back towards 2%. I see a labor market that continues to soften but remains around full employment. But there are risks around this baseline outlook, and they're two-sided. On one side, it is possible inflation could turn out to be more persistent than expected. Now, that could happen because of tariffs or for other reasons that we are unaware of now. And the labor market, the risks of labor market weakening have increased over the summer. So those are the two-sided risks. At the last policy meeting, I supported a reduction in the interest rates as an insurance against further labor market weakening, while continuing to lean against inflation. So from my standpoint, monetary policy is now somewhere between modestly restrictive and neutral. And looking ahead, the way I see policy is I'm open-minded to future potential reductions in interest rates. I do believe we need to tread cautiously because the room between now and the point where policy could become overly accommodative is limited. On tariffs, just for a minute, our team in St. Louis, the economists in St. Louis, and the research group have done a fantastic job of parsing out the impact of tariffs on inflation. And the answer to that question is the impact has been more muted than expected. So, for example, inflation is running somewhere between 2.9 and 1% and 3.1%, depending on whether you look at core CPI or core PCE. Our economists have figured that only about 2 to 3/10 of that inflation is driven by tariffs at present. So tariffs so far have only been responsible for about 10% of inflation, which means that most of the inflation and the persistent above target inflation is driven by things other than tariffs. I personally believe that it's important to lean against above target inflation independently of how it's generated, whether it's generated by potential tariffs, by lower labor force growth, or for any other reason.
Thanks, Alberto. It's so important to hear from the current Federal Reserve Bank president about his views on the economy right now, and I appreciate you doing that. So let's rewind. Tom, You became the St. Louis Fed president in 1985, and that was on the heels of Paul Volcker and the taming of inflation and stagflation of the 1970s, and you were also at the FOMC table when Alan Greenspan became the Fed chair in 1987, and the Great Moderation was underway. So tell us about those remarkable eras, the pressure on the Fed's credibility, and the lessons the Fed learned.
Thanks, Karen. Is this working okay? So when I came in 1985, the Volcker FOMC before me had done a great job in wrestling runaway inflation to the ground. But the job was far from done. It took a number of years after that to really wring future inflation expectations out of long-term interest rates. So when Greenspan came in '87, before I say that, I should comment that Volcker was the right man for the job at the time he came in, because he had been New York Fed president. He knew all the players in the Fed. He knew the system and how it worked. And what they had to do to get that inflation under control was remarkable. And he was the kind of leader you needed to get that done. Greenspan obviously had been around economic circles, but he had not been in the Fed before. I'm sure he talked a lot about it and had plenty of views about it. But when he came in '87, he fired what I would call a very strong opening salvo in the markets by raising the discount rate 50 basis points, which at that time was the only way to make it immediately known to the public that the Fed had changed policy. There were no public releases as the Fed changed the funds rate and so forth at that time. So that was a really bold move on his part, and he did it within a month of being in the job. So he made his mark very quickly. I would say in general, Greenspan was very good at sort of anticipating, trying to stay ahead of where policy should be and not make policy by looking in the rearview mirror, if you will. And so it was termed preemptive monetary policy. But in terms of inflation expectations, it was really, I guess the icing on the cake was in 1993 when Greenspan and the FOMC raised the funds rate by 300 basis points. And there was a lot of anticipation in that. Eventually they had to roll back some of those increases. But at that point in time, long-term markets were convinced, and this is, you're talking quite a few years after the inflation got out of hand, close to 15 years, to really reestablish credibility. So they were both great chair people, and I would say together, by getting inflation under control in the first instance and then wringing out future inflation, they did, as Karen described, lay the foundation for the Great Moderation, which was a long period of years that went all the way up to the financial crisis, where economic growth and inflation were both relatively stable. I mean, obviously there were wiggles here and there, but nothing like we've seen in more recent years.
Thanks, Tom, and that's a great segue to Jim. Because Jim, you were at the St. Louis Fed when a completely different dynamic was at play. After the Great Recession of 2007 to 9, inflation was below the Fed's 2% target for about 13 years. And meantime, the Fed funds rate was essentially at zero. So it wasn't that you had this tool that you could use. So talk about the challenges of that era and the other tools the Fed used to navigate it.
Yeah, I learned so much from Tom Melzer when he was president of the bank and I was on the research staff, and then I was promoted to president, and the world had flipped upside down. And basically all the previous lessons that you thought you had learned from this earlier era didn't work anymore. So a lot of attention appropriately to financial stability. Dodd-Frank Act was passed in 2010, I guess. Which changed, a lot of the large bank regulatory issue settings for the Fed and for the nation. But something else surprising happened, which is that the recovery from the global financial crisis was very slow. There was research at the time that predicted that it would be very slow. That was debated at the time, but that it turned out to be right. That if you have a big downturn for whatever reason, a lot of times the economy will bounce right back. But that didn't happen from 2010 to 2019. Instead, we got a very slow recovery, and that shaped a lot of thinking about the Fed and about the positioning of interest rates. And so we had this incredibly long era of even negative nominal interest rates around the world. At one point, I think over half the sovereign debt that was issued all around the world was at negative nominal rates. It's something you wouldn't even consider possible in the 1980s and 1990s when I was in my formative years of studying macroeconomics. So, but with a 2% inflation target, you really want to make sure that if you're going to have a target, the whole game is to be credible about the target. So if you're going to have a target, then hit the target and conduct monetary policy to hit the target. And so I advocated for that during this period. We would do whatever we needed to do to get inflation to 2%. Not every country did that around the world. Japan is a notable example that hasn't, for 25 years had very, very low inflation and always said that it wanted more inflation, but didn't get it. I think, the lesson for today is that it's possible that you could have a big shock again in the future. It's possible that you could go back to very low interest rates. But having been through it once, we kind of know something about the playbook and what works and what doesn't if we get into that situation again. So I think that's the main lesson from 2010 to 2019.
Thanks, Jim. And speaking of the inflation target, Tom, I think you were the first Fed president to bring up inflation targeting at an FOMC meeting. But it wasn't until maybe 12 years later that the Fed actually officially embraced it. Why did it take so long? And then fast forward to today, do you think 2% is still relevant? Should it be different?
Actually, I wasn't the first. I was told that by a Fed economist. I was an early one. I Googled it just to double check. And the first time I Googled it, it said I was first. Then I Googled it again later just to double check again. It said, well, I was an early one, but I was the one that stuck with it longer. And then the third time I Googled it, I couldn't even find my name. So who knows? But the idea in terms of setting an inflation target or the reason that we brought it up at the time at the St. Louis Fed, and I was the messenger, was that there wasn't a good nominal anchor, if you will, for monetary policy. Money supply growth was not really doing its part. The relationship between money growth and the economy had largely broken down, and there was a feeling that we needed something. So why not go all the way to the end game and pick inflation? And perhaps more important, why not have an inflation target? And at that time, I don't think we were advocating any number, but why not have an inflation target if really in the long run, the only thing that monetary policy can affect in the long run is inflation? And there may be others that debate that, but I think that's a pretty important principle.
Great, thanks, Tom. Let's switch gears and let's talk about how the Fed makes its decisions and data dependency. So Alberto, over to you. Explain the role that data plays in Fed decision-making and what are the key data sources that the Fed relies on?
Thanks, Karen. So I'm not going to talk about data dependency because I believe in being forward-looking rather than backward-looking. But I'll explain how data dependency gets into that. So incorporating all available information at every time that we're making decisions is really critical. And I and the Fed more broadly look at three types of information. We look at data, we look at anecdotes, and we look at what markets are pricing in for economic outcomes and policies. In terms of data, we look at data from public sector agencies in the US and abroad. We look at data from international organizations. We look at data from private providers, all kinds of data. Importantly, that data are inputs into models that are forward-looking models that allow us to make forward-looking what-if type simulations. Now, what if policy were this? What would happen to the economy in the future, et cetera? So that's really important. Data integrity is critical. Data availability is critical, and it's important that going forward, any opportunity to improve data integrity in government agencies is taken, it would be a good thing. In terms of anecdotes, as Karen said at the beginning, part of the job of a Federal Reserve Bank president, but the entire Federal Reserve Bank, is to be in constant contact with the communities, businesses, households that we serve across our districts. And as Karen said, there are 12 districts around the country. So I get to talk to business people, community leaders, households, all over 7 states. And those folks provide anecdotes about the local economy, the regional economy, the national economy, and in some cases, in the case of large businesses, the global economy. And so those anecdotes are really important because they also are forward-looking, because those anecdotes become data 3 to 6 to 9 months in the future. So again, another forward-looking aspect of it. And that information is critical for me when I'm sitting at the FOMC table making my case for policy. Often a conversation pops to mind that I had with someone. And sometimes I convey that conversation anonymously, but I will say things like, a retailer from this part of the country said the following to me, and all the other presidents do the same. So anecdotes are hugely important, and they're forward-looking. Lastly, I derive a lot of information from financial markets. Financial markets move trillions of dollars a day, so there's a lot at stake. They are perhaps the best aggregators of information and forward-looking aggregators of information that we as humanity have today. So I try whenever possible to go to markets and understand what is priced for growth, for inflation, for unemployment, for the policy path, for the path of the dollar, for the path of the oil market. So again, these are forward-looking impressions of what's going to happen. So taking it all together, I view as my responsibility to the public to take all those inputs continuously and continuously update my forward-looking view about the outlook and the balance of risk for the economy, and therefore my recommended policy path. So that's how we use data. Data dependency always seems backward-looking, and the truth is it's an input to make forward-looking assessments.
Thanks, Alberto. So Jim, to that point, so data are from the rear view mirror, but projections can be wrong. So talk about some of the data curveballs or prediction curveballs that the Fed maybe even threw at itself in the past, and how that affects decision-making and public trust.
Well, you had one last year. Last year at this time, the committee thought that the economy was slowing down. They thought jobs growth was slowing down. That was the data that was available at the time. They did make a move at that time, but then later, some of that got revised. Some of the later data was stronger, and the committee had to slow down and eventually pause its rate cuts. So that's an example of, you make the best decision you can based on the available data, but unfortunately in macroeconomics, the history keeps changing on you. An example about how the world of data is changing is from the pandemic. I think the future is about more real-time data. So here's the anecdote. In the second month after the pandemic hit, of course, employment is going down, but it's not just going down a little bit. It's like totally tanking, going way, way down. And Wall Street was predicting that the May jobs report, which would be the first week of June in 2020, they were predicting that the May jobs report would be minus 10 million. So it's just outrageously big number, but that's what was happening during the pandemic. You know, all these people couldn't go to work, and of course they were having all this trouble. So we had an analysis at the bank a few days before the jobs report, and one of our team used real-time data. So this was some data that was available, daily or weekly. And I said, great, it's great that you're doing this. What's your prediction for the jobs report? He said, plus 3 million. So that would be 13 million higher than what, what Wall Street was expecting. So the date came of the jobs report. This is all during the pandemic. So I'm sitting out on my back porch over here in Clayton. And the jobs report comes in plus 3 million. So he had it exactly right based on the real-time data. Wall Street was off by 13 million jobs. So I think that I actually sent a email to everybody, all the researchers in the Fed system saying, hey, we're in a new moment here, and maybe you should pay a lot of attention to real-time data. So I think you could probably do a lot more, and the Fed has done a lot more with that since then. It's not a panacea. Sometimes it leads you astray, but that was a particular instance where paying attention to a particular type of data was going to really help you at a turning point moment in the economy.
Thanks, Jim. So yes, data, projections, analysis, but there's also a lot of people and voices around the FOMC table. Tom, is the chair calling all the shots? So talk more about the deliberation process around that big table.
Okay, certainly not calling all the shots. The chairman is 1 vote out of 12. There are 7 governors with votes, including the chair, and then there are 5 presidents at any one time that are voting. And so obviously as chair, he's got some extra authority, but only 1 vote. So I always viewed the job of the chair as being to build a consensus on the FOMC and making sure whatever policy recommendation is advanced, it's near the center of gravity of where the FOMC is at any point in time. I can give you an example in my experience where Paul Volcker was chairman. I was voting for the first time, and I dissented in one of the early meetings because I didn't think rates should be cut further. And Henry Wallach, a governor, dissented as well. That was all well and good. A chairman is really willing to take, I think, generally 2 dissents, but they don't want to take more than that in the same direction, in my experience. The next meeting, same issue. I dissented, Wallach dissented, and there were 2 other potential dissents. And Volcker had to reformulate the policy. I thought to myself, this guy supported your candidacy and you're dissenting in back-to-back meetings, but my view was, that's my job. If that's what I believe, that's how I have to vote. Interestingly enough, he came to me a couple of weeks after, well, he didn't seek me out, but I happened to be in Washington on another matter. He said to me, by the way, you've had a very positive impact on policy lately. And you could have knocked me over with a feather. But I think basically what was operating there, and that's what opened my eyes, where he was getting away from the center of gravity of the FOMC. So there haven't been a lot of dissents in recent years, but I think it's an important part of the process. And I think that answers your question.
Yeah, it does. Thank you. All right, let's turn to the issue of Fed transparency. You know, I was an intern at the Board of Governors in 1987, and the book Secrets of the Temple came out. So it was a groundbreaking look inside the Fed, which it called secretive and mysterious, among other things. So the Fed's come a long way from those days. Jim, you've taught me a lot about that journey. So talk about the Fed's journey to transparency, and why was it important, and how has it changed monetary policy making?
So I think to understand Fed transparency, I think the Volcker era was much less transparent. As Tom was just saying, In the Volcker era, the committee made no pronouncement at all. The meeting would just end, and that was the end of the meeting. There was no interviews, no press conference, nothing like that. During the Greenspan era, there were some attempts to get a little bit more transparency, and some things did start to happen. The committee did start to issue a terse statement. I think at first it might have been one sentence, and then later blossomed into more. But it's really Bernanke. Bernanke came in, and Bernanke did not, as a rule, did not like the imperial chair kind of idea that Greenspan had. And Greenspan had had so much success for so long that he was kind of a towering figure. But Bernanke wanted the democracy of the committee. He felt you could get input from across the committee. You should be more transparent in your goals. He was an inflation targeter. He thought you should name an inflation target and then take action to get to the target. So I think it was a watershed moment for the Fed, and most of the transparency moves came right around that era, including the naming of the inflation target. So, and also I think it set an international standard for transparency. We eventually got press conferences at every meeting, which is something all central banks are doing now, and other aspects of transparency along statement, a framework statement that comes around every year. So this has made it much less secrets of the temple and much more, here's what we know, here's the data we have, here's the forecast we have, here's the best policy we can design given all the uncertainties. And so I think it's really been a remarkable evolution over that time period.
Thanks, Jim. You know, it's said that people don't trust what they don't understand. So Alberto, I'm curious, what's one misconception about the Federal Reserve that you wish more people understood?
So I'm gonna change tacks a little bit. This is not so much a misconception, but an area I think deserves more awareness, and that's the vital role that reserve banks play all around the country, and there are 12 of them, in promoting a strong, resilient economy for all. And let me just elaborate on what that means. So for monetary policy, reserve banks are a cornerstone of independence. Monetary policy affects every American all over the country, and having reserve banks that span the country and are in constant contact with the people they serve means that the voices of those people are represented in monetary policy and the monetary policy table. And for a country as large and as complex as ours, with $30 trillion economy, 340 million people, and a complexity of sectors and communities, it's important to have a system that spans the entire country and brings all those voices to the table. So I think that's pretty critical. In that vein, the St. Louis Fed, before I got here, before my predecessors got here, for 110 years, has been impacting the 8th District in a very positive way. Another thing that is often not as well understood about reserve banks is that beyond being a cornerstone of monetary policy independence, they also provide tremendous services to the economy. For example, the supervisory staff of reserve banks keeps the financial system, or helps keep the financial system, sound and stable. And that's because they supervise all the banks and the financial institutions under delegated authority from the Board of Governors, and that's financial institutions with about $30 trillion in assets. Another thing that reserve banks do is they contribute to operating the national payment system. And so the payment system runs every day. Every time a transaction happens in the economy, the payment system is involved, and that's $5 trillion per day in transactions. So that's a very meaningful backbone of the economy. And reserve banks also are very engaged in consumer protection and in community development. And reserve banks are also engaged in providing fiscal services to the U.S. Treasury fiscal agency services, which means providing banking services to the U.S. Treasury. So it's often not as well understood what the reserve banks do, but they really are a very critical part of the Federal Reserve.
Thanks, Alberto. We're going to talk about the St. Louis Fed here in a minute, but first let's talk about a topic that I think probably half of those 90 questions were about, and that's Fed independence. As we talked earlier, the Federal Reserve Act of 1913, Congress made the Federal Reserve an independent central bank with the ability to conduct monetary policy without direct political interference. So it's not subject to the annual appropriations process that other federal agencies are. It can't be closed due to a government shutdown. And the Fed leaders can't be fired because they raised or didn't lower interest rates. But with that privilege of independence comes a profound responsibility for accountability. So let's talk about the current situation with the Fed's independence. But Tom, I think the perspective of the long view is a really important way to start it. So Tom, there's tremendous political pressure today, and some would say it's unprecedented. But put this in perspective for us. Has it changed, and what was it like when you were at the FOMC table?
There was a time where there was a lot of pressure in the early to mid 1990s. And by the way, typically, in my experience, it was coming from Congress because the Fed is a creation of legislation and is accountable to the Congress, and the chairman testifies twice a year to both House and Senate committees. And it's often in that format that you hear some flack. But in the opening legislative session of 1993, Henry Gonzalez, a congressman from Texas, introduced the Federal Reserve Accountability Act. And a key provision of that was to make every Reserve Bank president appointed by or nominated by the president and confirmed by the Senate. So think about that for a minute in terms of if that gone anywhere, you would have a central bank today where everybody involved in the policy making process got there through a partisan process. Fortunately, that never happened. The House didn't pass it. The Senate didn't pass it. The pressure today from the administration is different. It's not where it typically comes from. I would, just mention, for example, generally, and Robert Rubin was a good example of this when Bill Clinton was president. Bill Clinton had a big public megaphone if he chose to use it, and one would have thought maybe he would use it to get the monetary policy he wanted. Never did, because Rubin told him, you're only going to, hurt yourself if you speak publicly about it. And all that communication historically has taken place between the Secretary of the Treasury and the head of the Fed, chair of the Fed, in weekly or bi-weekly luncheons. So different times today.
Yeah, thanks, Tom. Jim, any more to say about this in terms of the importance of independence and also how the Fed is accountable?
Yeah, I think one aspect of this is that we use the word independence, which maybe connotes that you're off on some other island or something like that. It's not really like that. You do have the Board of Governors. They are political appointees appointed by the President and confirmed by the Senate. So it's not that you're totally divorced from politics. It's that you're trying to keep the process of making these important monetary policy decisions at arm's length from the day-to-day machinations of inside the Beltway, Washington. And if you allowed the political turmoil inside Washington or the sort of the bickering between the parties and the policy twos and fros between the parties, you don't want that to turn out also be in interest rate policy. And now today we're going to lower interest rates. The next day we're going to raise interest rates. Then we're going to raise interest rates again. We're going to lower them again. That's just introducing a lot of volatility into financial markets. It doesn't need to be there. And what happens inside financial markets then is you say, oh, it's going to be very volatile. I'm going to have to put a risk premium in before I buy any of these securities or these bonds or anything, because I'm not sure which way the politics is going to go. So you want to keep all that out, but you still want some political influence over the interest rate policy, because it's an important policy and it's a democracy. So I think the Federal Reserve Act does strike a balance. It's brilliant in many ways, and the founders thought very carefully about this issue because the first two central banks of the United States had failed exactly because of this issue. So they decided to create this system where you had decentralized power across the country, you had the reserve banks across the country, you had important representation on Wall Street in the financial capital, but you also had the Board of Governors in Washington, D.C., politically appointed governors for the whole system. So this is done pretty well over a long period of time. If all parts of the triangle are doing their job well, then I think you get pretty good calls on monetary policy.
Thanks, Jim. We've got about 10 minutes left, so I'm going to pick up the pace. But Alberto, before we leave this discussion of independence, some would argue that the Fed's actions disproportionately benefit Wall Street versus Main Street. How do you respond?
As Jim was saying, the Congress appreciated from the start the importance of monetary policy independence of the Fed. So in the Federal Reserve Act of 1913, that was the case. In the 1935 Banking Act, that was the case. In the 1977 Federal Reserve Reform Act, that was the case. And Congress was very supportive of independence during the 1951 Treasury-Fed Accord, which demarcated fiscal policy and monetary policy. So the dual mandate, which is maximum employment and price stability, evolved from this arc of history. And to me, it is current law, and we need to follow it. And to me, it's about maintaining the 171 million people that are in the labor force maximally employed. And it's about keeping the 340 million people in the country from having their purchasing power of their income or of their savings be eroded away by inflation. Incidentally, inflation is a very regressive tax. It's a tax on everybody, but it's a very regressive tax, particularly on low, moderate income households and folks on fixed incomes. So when I read the Federal Reserve Act and when I read the dual mandate, to me that sounds like completely focusing the Fed on Main Street and not on Wall Street. Now, if Main Street is doing well and the underlying fundamentals of the economy are healthy because Main Street is doing well, then Wall Street probably ought to do well too.
Okay, thanks. Let's move on to maybe one question about financial stability. Financial crises like bank runs and bank failures and contagions, that directly led to the creation of the Fed back in 1913 to create financial stability and a lender of last resort. The Fed learned a lot, I think, from the financial crisis in 2008 in terms of how to manage stability there and how it might have contributed to it. And I'm not sure we really have a lot of time today to talk about that. But there were several questions, Alberto, that were asked about the Fed's role and what it should be in regulating fintech and cryptocurrency markets. So any thoughts about that?
Thank you. So in terms of fintech, in 2023, the Board of Governors issued a guidance to banks, which are what we regulate, our banks, of how to manage risks and how to comply with applicable laws in their relationships with third parties, so bank relationships with third parties, and that includes fintechs. So that's the scope within which we can be involved in fintechs indirectly through the regulatory perimeter, which is the banks that we regulate. In terms of crypto, I'm going to talk about stablecoin. The audience might be aware that the Genius Act was passed in Congress a couple months ago, and the Genius Act is the regulatory framework for payments stablecoins. And from that act, I would expect the Fed to regulate the bank subsidiaries, again, through the banking system, which is what we regulate, bank subsidiaries or subsidiaries of banks that issue stablecoin, for which the Fed is already a primary regulator of the bank in question. I would expect the OCC to regulate non-bank issuers of stablecoin. For crypto more broadly, it's the SEC and the CFTC are focused on that.
Okay. So let's move a little closer to home and talk about the St. Louis Fed. Jim, I'm going to start with you. Tell the story about the role that the St. Louis Fed played with the monetarist school of thought from the 60s to the 80s. You've told this story to so many, and very proudly so. So give us a synopsis of it here.
There was a time when the Federal Reserve did not really have the kind of academic-style research departments that they have today. In the post-war era, people started to think about, hey, maybe we need to beef this up, get better analysis to support monetary policy decisions. Analyzing the economy is a big, complicated machine that you've got to try to figure it out. And why rely on other people to do the research? Why shouldn't the Fed just do it itself? So the genesis for that sort of thinking within the Federal Reserve System started here in St. Louis with the hiring of Homer Jones in 1958. Homer Jones was a teacher of Milton Friedman at Rutgers and later a student of Milton Friedman at Chicago. And so the whole genesis of academic-style research in the Federal Reserve System started with St. Louis. There was tremendous success because the bank published the so-called Anderson-Jordan paper in 1968 or so, which later became the most cited paper in all of macroeconomics. So it was very much cutting-edge paper. It was very much contemporary econometrics analysis at the time, and so they really ran with the ball. After that, lots of other of the Federal Reserve banks started to copy this strategy, and so today you have very, very good research departments all around the Federal Reserve System that are thinking about all kinds of important and interesting issues within the macro monetary area, and I think that's been very powerful. Not only did that occur in the U.S., the U.S. was a leader, but now across the world, certainly the ECB, very strong in the research world, and others as well, smaller banks like the central banks of Norway, Sweden, Bank of England, other places, Reserve Bank of New Zealand, tiny country, but has had an outsized influence. So this is all part of a process that started here in St. Louis those many years ago. And Friedman was obviously a very powerful and influential figure in the 20th century and maybe a little bit into the 21st century. But, those days are kind of behind us, and it's up to the current crop of researchers to articulate the agenda going forward.
Thanks, Jim. Okay, unfortunately, it's time to start wrapping up. I'm going to leave some of the questions off to the side. But for each of you, in just a few words, what do you see as the most significant challenge the Federal Reserve will face in the next decade? Tom.
This is a little inside baseball, but I think the balance sheet is a big issue for the Fed. It's at $6.6 trillion now. I don't know where it needs to be, but in my opinion, much lower. So I think the challenge to the Fed is that we're also likely to again be in a zero interest rate bound economy at some point in time. And so this quantitative easing tool may need to be used again, but I would suggest that it be used more judiciously than it was in the past, and that an exit strategy be determined very clearly up front in terms of how to get the balance sheet back down.
Thanks, Tom. Alberto.
I think a challenge that we control is continuing to tell the story of how the Federal Reserve is a source of stability for the economy, and how on a daily basis it's working towards just a stronger and more resilient economy for all. Telling that story.
Jim.
I think we've struggled with what the role of the U.S. is in the global environment and how the global environment comes back to influence Fed policy and U.S. macroeconomic policy generally. Now we have a fragmenting world, apparently, and I think it's important to try to understand that going forward. So I see that as a key challenge in the years ahead.
Thank you. And my last question, it might be really reflective of what you've just said, but we have a lot of students here today, and these are curious minds, critical thinkers, and they're the leaders in the economy of the future. So what topics, or throw out a topic or an issue that you would really encourage them to really wrestle with and learn about going forward. Tom.
I would say as an electrical engineering undergraduate, to the liberal arts students in the audience, take some economics and finance. Whether you go into that field at all, it's going to serve you well in your life personally.
Alberto.
I would say begin to understand the economy. It's a very important place where we all come together, households, businesses, the government, financial markets, and it's a really important place where things happen. Engage with the Fed, understand the Fed. The Fed has 12 websites and reserve banks, and then the board has a website. Each one of those reserve banks and the board has multiple social media channels. Engage with the Fed, understand what the Fed does. And lastly, if you're a data geek like I am, visit FRED. FRED stands for Federal Reserve Economic Database. It started here in St. Louis in 1991. I've been an avid user since 1992 when I was a graduate student. And I think there are 880,000 series there that you can lose yourself in trying to understand the economy.
Jim.
You're probably already thinking about it, but artificial intelligence is a major disruptive force in the economy, and I would encourage you to learn as much as you can about it as a student. I think what will happen is that there are lots of companies out there that have existing groups of employees. Those employees will look to you if you come in with some knowledge about AI, and especially not just the gee whiz aspect, but how can you actually use it to actually improve productivity and business processes. That's really what every company is looking for. And so if you have any insight on that, you're going to be very valuable in the market.
Jim, Alberto, Tom, it has been delightful. Thank you for your service to the St. Louis Fed, to the Federal Reserve, and to the U.S. economy. Please join me in thanking them.
So we have, in fact, come to the end of this really extraordinary program. I want to take a moment to again thank our panelists, President Melzer, President Musalem, President Bullard. Thank you for sharing your insights and perspectives with us today. And thank you to our moderator, Karen Branding, whose thoughtful moderation guided us through a really rich and engaging conversation. I also want to extend my gratitude to Rich Reifel, Executive Director of Business Leadership at Purdue's Mitch Daniels School of Business, and more importantly, Senior Fellow at the Weidenbaum Center, for his vision and hard work in making this event a reality. I also want to thank the Weidenbaum Center team, especially Alana Baim and Elizabeth Larson, as well as the team from the Federal Reserve for their partnership and support. Events of this scale and significance don't just happen. They are the result of tremendous efforts behind the scenes, and we're deeply grateful to everyone who made it possible. Finally, thank you so much to all of you for being here today. I hope you'll join us again soon. Our next event is on October 16th at 3 p.m., where we'll hear from Karen Howe about a fascinating new book, appropriately enough, on artificial intelligence. It promises to be another timely and fascinating conversation. So again, on behalf of the Weidenbaum Center, thank you for joining us. We wish you a wonderful afternoon, and please join me once again in thanking our terrific panel.